More than 3/4 of British mutual funds investing in Europe have beaten their benchmark this year, according to Morningstar. They've done so by being cautious, staying out of economically sensitive stocks and out of China-related stocks, to such an extent that there's a strong clustering of outperformance on bad days for the market and of underperformance on good days. It's not just London fund managers who are bearish. Sentiment may not be as negative as it was in 2008 or 2009, but Merrill Lynch points out that short interest in US stocks, that is, bets that prices are going to fall, is now the highest since the post-Lehman crash. The question is whether investors are gloomy enough to provide a solid base for a rebound. Now, the answer is nuanced. There hasn't obviously been a capitulation across markets as a whole, when shareholders are gripped by pure fear and indiscriminately dump anything with a hint of risk, although that does seem to have happened in some areas, such as Glencore shares and perhaps in broader mining stocks. A survey of fund managers running $4.8 trillion of assets carried out last week by Absolute Strategy Research gives a taste of this. The weighted probability of a global recession over the next year has risen to 39%, from 28% in the past 3 months, and that comes even as 2/3 of them expect further Chinese devaluation. Now, the post-Lehman experience was extreme, and it would take a truly bearish personality to expect a repeat of that anytime soon. So rather than worry about whether the last bull out there has finally given up, consider instead what the pain trade would be, the move in markets which would hurt the most. Increasingly, that looks like it will be a bounce, but again, not so convincingly as to make it inevitable. This survey question shows how investors have become more cautious on cyclical shares, those which move with the economic cycle, with an increasing confidence this year that defensive stocks will do better. Broadly speaking, the higher the green line on this side, the more people have moved from March to June to September in thinking that defensive stocks will outperform, and again from March to June to September in thinking that cyclical stocks will outperform. That's been coming down obviously for cyclicals and improving for defensives. Now, the broad trend that this shows has been underway ever since the financial crisis, with investors preferring to buy boring shares as they search for alternatives to low-yielding bonds. This chart here shows how the most boring US stocks, so-called low beta shares, least sensitive to market moves, have been re-rated by investors since 2009. The low beta valuation, measured as a multiple of book value, is the red line here, and you can see that that's now at a premium to the wider market in the US, the blue line. Now, at the start of this year, it actually reached its highest in absolute terms since at least 1984 at 3 times book. That's pretty expensive, especially when you consider it had been back in the financial crisis at half that level. I should say, though, that the gap between these two valuations had been narrowing for the past couple of years, up until this summer, so the premium for those low beta stocks have been coming down a little bit over the wider market after rising an awful lot. Now, it would be foolish to conclude that shareholders can't become more worried and that a further decline in the market or in cyclical stocks was highly unlikely, that people were now so bearish that they couldn't get any more bearish. But investors should be very wary of being caught up in the melancholy atmosphere. At the very least, they need a really good reason to join the crowd now and switch out of bullish into defensive positions.